We argue that will be the point at which the folks in the Fed, without admitting so, will start to get very concerned that they've done what some major asset managers said three rate hikes ago. You've gone too far. In which case they'll start to reverse. What's the beneficiary of the resumption of monetary excess? Gold.
This is Kaiser Johnson with Liberty and Finance, and this is the Miles Franklin Weekly Special for August 14th through August 21st, 2023, while supplies last. This week we feature silver buffalo rounds minted in the style of the famous U.S. Buffalo nickel and are made by multiple private mints across the country, but are all 1 ounce of silver, 3/9 fine, and instantly recognizable, making them a great and inexpensive way to quickly stack silver with the flexibility of 1 ounce rounds. They are available at just $2.50 over spot. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today is our good friend Michael Oliver from Momentum Structural Analysis, olivermsa.com. Michael, thank you so much for joining us today.
Good to be back, Elijah.
Well, it's great to have you. Now, I did want to first discuss the financial sector and the banks. We've continued to see some banks fail or get taken over, right? PacWest and also a small Kansas bank. Your perspective right now, what we're seeing in the financial sector, I know you have a lot to say here.
Oh, yeah. I think the key for gold now, and gold is a leader market. It doesn't wait for events to happen. It anticipates them. After all, it's been around several thousand years. You name me a market that's been around that long, okay? It's held its value for millennia, okay, against government degradation of money, okay? Okay, now, what we have is the topping of the stock market early last year by our metrics. We said, that's it, that the market is making a major top. Now, we did this in year 2000, in January, and the market labored around and even made a marginally new higher high later in 2000 and then collapsed. It did it in 2007. It topped. We knew it was topping in late 2006. We said it was topping in late 2007, and it fell apart by late 2008 with counter-trend rallies. But the stock market was incredibly stupid at each of these highs. It never realized it had been a bubble. This time it's the biggest bubble in U.S. stock market history. 7-fold increase in S&P, 16 in NASDAQ 100 over a span of 12 years. Created by excess monetary policy, free money, false cost of price of money created by government. Errors were made over many years and with great dimension. Not only government errors in spending and planning, but corporations, family planning, all these things were effectively hallucinogened by injections from government monetary policy. Okay. Once this bubble starts to break, it's the bubble that the Federal Reserve and other central banks of the world, they always move in to defend. They don't care if the corn farmers aren't making enough money or the sugar farmers or the oil producers. They care if your stock market's going up because often it'll interact with and hurt government debt markets and so forth. So when they finally perceive that they have burst the bubble and that the bubble was far bigger than they anticipated, they're going to reverse policy. It's a given. That's what they do. That'll just mean the Fed. They're stupid. They're always lagged to reality. You can go back and look at history of their rate rises and then their rate cuts when they occur. Okay, if they go on a rate cut policy now, it's not going to help the stock market. It didn't help in 2007 through 2008. They cut rates like crazy. They cut rates starting in January of 2001 all the way to the bottom. Market still went down. So when they start to cut rates because they get vibes and phone calls, no doubt, behind the scenes from major banks, they're going to get concerned. They're going to plateau. They're going to do the pause. Okay. And everybody thinks, oh, that's good for the market. No, it's not, because it's acknowledgement by the Fed that something is amiss. The beneficiary of this, again, will be gold, because they'll go back to a policy of monetary excess to defend muni bonds, U.S. government bonds, and the stock market. Unfortunately, a lot of gold bugs and who are depressed all the time now the last 2, 3 years because it's stalled, which is really the fact. It's not gone down, it's stalled. They don't recognize that gold is not directly correlated to the direction of interest rates in the stock market. They seem to think that if the stock market goes down, oh, that means, quote, deflation, and it means gold will go down. And if rates stay high, gold's going to go down. Well, throughout history, this is not true. What gold is watching right now, I think very closely, is it's watching the stock market. Because when that stock market finally rolls over from this secondary rally effort that it made for the last, well, actually 12, 13 months since the lows of 2022, try to get back up to the highs, couldn't do it. Apple made a new high and immediately failed. Microsoft made a marginal new high, just enough to tease people, then failed. NVIDIA went ballistic and now is topping. The SOX index, which is a leader sector, is now topping. The thing to watch, though, is what we said back in late January, excuse me. We issued a report saying, watch out for a bank ambush. At that point in time, the banking sector was behaving better than the stock market, no matter how you measured it. For instance, in 2022, when the S&P made a low in June, made a lower low in October, bank sector didn't. It held the June low. Behaved better on the downside. And then on the upside into early this year, the bank sector was stronger. So it was a happy sector. And we warned there's an ambush coming. Well, the ambush hit and we had effectively what was a crash in the banking ETFs, particularly the regionals. But the Fed dismissed it and said, oh, it's badly planned couple banks who are badly managed. And in other words, don't assign the responsibility to the boom bust cycle that's created by the central banks. Blame it on some bank manager. And it's a regional, so it doesn't matter, right? Okay. Well, we've noted that in that drop in the banks, and I suggest to all your viewers that they go on their quote screen and punch up, for example, Citicorp, C is the symbol, or Bank of America, BAC, or Wells Fargo, WFC. These are 3 of the 10 too big to fail. Okay. If you look at Bank of America and Wells Fargo, they took out the 2022 price lows in that March drop this year. So they joined the regionals in terms of price breaking through the lows of the prior year. The other major too big to fail banks did not do that. They held above the 2022 lows. No doubt the Fed wiped their brow and said, oh boy, good. Okay. Because they can't afford to have any sense of concern out there. Doesn't even have to be a hard story, but just any sense of concern that, my gosh, watch the big banks. Well, we focused in on Citicorp because when it came down this March, it held just in front of the 2022 lows, which were, by the way, the same lows it made in 2020. So it's really going back 3 years now, 20, 21, 22, and now we're into 23. It's 3 years of lows where the price level is just a few dollars below where Citicorp is right now. So our assumption is that the sector to watch, instead of the leaders, the tech leaders, the Apples, the Amazons, the heavily weighted symbols, the semiconductors and all that, they're turning down. So you're losing your leaders, but watch the big banks, because that's an arena that the Fed is most concerned about. And they're not real smart folks, so it's going to take a smack in the face before they realize that, oh my goodness. Well, if you just look at a chart of Citicorp, punch it up, a weekly chart, go back a couple years, and then punch up. And now, in fact, we've got one. I sent you a chart of Citicorp and gold. And if you want a correlation between what gold is doing and some other market, I suggest you take Citicorp and put it underneath your gold chart, as I've done here, and you'll see their inverse. Whereas as Citicorp went down to its lows in 2022, gold was making a high. March 2022, remember? Okay. Gold was over 2,000 then. Gold then dropped down, had a false downside breakout. During that time, Citicorp was rallying. Inverse. Then again, look what Citicorp's done recently. It's come back down to its lows again. The lows of the last few years, just on price. We're not talking momentum. Momentum is worse than price, okay? But it's come back down to this floor that it's been living on. It's not going to hold it. The question is, when does it break it? Well, as Citicorp went down to multi-year lows, gold went back to multi-year highs. And over the last 4 or 5 months, Citicorp has had this holding action. And what has gold done? Not collapse off of its multiple highs up there in the 2000 level, but drifted. In fact, you can see it very clearly on this price chart. It's not been the type of drop that gold had in 2020 when it dropped from 2000 and went down to 1600 something, went back over 2000 again, then dropped down to low 1600s. This time it went over 2000, and gold for 5 to 6 months now is dawdling. Its percentage pullback from its high, the high monthly close in gold was 1999 this year. New all-time high monthly close, just below 2000. Well, we're trading right now about 1900. 5 months later, off the highs of the year, and we've given up, 5%? That's the same as Citicorp. It couldn't get off of its lows recently, just like gold can't get off of its highs. So I think if you're going to look at a market that might be a perfect mirror image of gold, watch Citicorp. And you can bet that the Fed will be concerned if Citicorp melts through those lows.
And why is there that inverse correlation in your view?
I think the banks will be being lenders. If there were false assumptions made based on protracted views of what the cost of money is and is going to be, they made investment decisions, loans, and commitments based on that in various forms over various timescales to various borrowers. And this is true with all the banks, not just regionals, but the big ones. If over that dozen years of false data input created by false cost of money, which is like the most essential commodity in human exchange globally, is the means of exchange between people. It's an essential commodity. And yet governments throughout the world, especially the Western governments over the last 10, 12 years, that'd be Japan, Europe, and us in particular, not China so much. China, it didn't create a bubble, actually, which is kind of weird. Okay, they didn't go on a money berserk period like we did. But it creates distortions because individuals and corporations make decisions based on certain variables. The commodity they're producing, the cost of labor, availability of materials, but also a major factor always is the price of money, the cost of money, interest rates. And if it's distorted and it's injected into their arm for a dozen years that it's going to be free forever, in effect, they make mistakes. And no doubt the biggest bundle of all those mistakes is focused in the lending arena. Now, another area I would watch is something a bit broader. And I would punch it up on your screen, XLF. It's a financial sector ETF. It includes the big banks, but it includes insurance companies, it includes Visa, MasterCard, American Express, and it includes some of very big asset managers. So it's a quite diverse, broad financial sector ETF. Look at that chart of XLF going back a couple of years, and then overlay an S&P chart. And as you see the S&P shoot up, and mainly because 2 or 3 symbols, we know that, Apple, Amazon, et cetera, look at what XLF did for the last year. It almost looks like Citicorp. It's just sort of dead in the lower third of the price range of the last couple of years. It didn't go down with the market going up, but it didn't go up with the market. Why not? What's wrong with the financial sector? Why couldn't it enjoy a good recovery like this S&P did? Watch it because it's the XLF right now, based on our metrics of measuring long-term momentum, is about to break structure again, which means that the holding pattern it's been in for the last, since the 2022 lows, just like the S&P, is over, and it's going to resume the downside. So if the broad financial sector and the too big to fail banks suddenly become an issue or a marginal issue even for the Fed, and gets noticed by asset managers who notice the anemia there. And suddenly they're awakened when Citicorp maybe makes a new low for the last 2 years. What's going on there? That will cause great concern. And you can bet that will be, we argue, that will be the point at which the folks in the Fed, without admitting so, will start to get very concerned that they've done what some major asset managers said three rate hikes ago: you've gone too far. In which case they'll start to reverse. What's the beneficiary of a resumption of monetary excess? Gold.
As for the timeline here, do you see that happening later this year?
Citicorp's already broken a structure to us. We put out a updated report, been watching for the last month. Not picking on Citicorp, by the way. It's just one of the biggies, and they all look pretty lame. But if another one of the biggies, aside from Bank of America and Wells Fargo, which took out the 2022 lows, if it suddenly joins in, and you look at its price chart and you say, gee, that floor won't last. If Citicorp joins in, then suddenly it's not an issue of regionals anymore. What's going on with the biggies? And no doubt there's some interconnectivity behind the scenes between these major banks and the Fed. We all know that. And so the Fed's going to get some phone calls from some of these bank heads talking about this or that problem that may or may not, developing under the surface, et cetera, et cetera. And no, the Fed won't have a press conference. But you can bet they're not going to raise rates again. Now, they've been talking hawkish. Even the other day when the minutes came out, we're going to, maybe raise rates again. Well, they're playing a game, and they don't realize what they're playing because they don't understand markets. These are not market people. These are academicians, or would-be academicians anyway. There's some academicians who understand the error in this, but they don't. But the monster they created over that dozen years, if they punch a hole in it, it's going to unwind like a balloon. And all kinds of real-world effects are going to hit. And I suggest it's going to be worse than 2008 and 9 in terms of the real-world, in-the-street pain that's inflicted on corporations and individuals and municipal governments and so forth. They're going to have to fund the debt again, meaning they're going to have to print, because as we know, for instance, the tax revenue issue, last year was a disappointment to them. They didn't expect that. 2022 was a non-capital gain year for most investors. I mean, the S&P was down over 20%, NASDAQ down 30-something, and T-bonds down 30%. Nobody had capital gains, so that's wiped off the deck. Now, we've had a rebound some this year, but the tax revenues are definitely sharply lower than the central bank had hoped and expected for. And now, all of a sudden, we're getting economic data points in other major markets of the world. I mean, markets that matter. China. China's second only to us in the world. You can't lose China to a market downturn, which it's in, by the way, the Shanghai Composite, by our metrics. It's a slow one, and it's not a bubble being broken. It's just an early phase of a bear market. In fact, where it was over the last year is only double the price where it was in 2009, whereas we were sevenfold, 16-fold. But they're turning down, and now suddenly we're getting deflationary type data points from China. China's even suspending their youth unemployment data. The youth unemployment skyrocketed. They said, we're suspending that data release. They know there's a problem there, and in their real estate sector in particular. So we can't afford to have that part of the world go negative. We can't afford, for example, Germany is always counted on its industrial sector. I just heard a data point the other day that the German industrial sector actually has gone negative. It is the core component of the German economy is now suddenly in question. You can't have that. So you American investors can't ignore that, because if they do, they're going to, one, be suckered by the stock market, and two, they're not going to anticipate what the Fed is going to do, which I think gold is anticipating what the Fed is about to do. It won't wait for them to do it. And it knows if the stock market rolls over, the Fed will shift policy, because there'll be real world waves associated with that. Pardon me for being so long.
I know back in, March and April, there was big concern for people having deposits in the bank, that the safety of that. So if we see problems in these big six banks, do you see any issue for depositors there?
No, they'll print the money. There's no issue. I mean, that's not an issue. The issue is whether they begin to destroy the money in it again, due to the emergency factors out there that come into play that they didn't anticipate for some reason. They never do. Okay. Well, I'm just telling you that from our assessment, this is the biggest bubble in U.S. paper stock market history, and including some other peripheral markets like municipal bonds and high yield corporate debt. So when the cracks begin to show themselves, both in stock prices coming down, a sense of negativity among investors and asset managers, this sense that the soft landing was another hallucinogenic notion. And by the way, the term soft landing was very popular in the summer of 2000. It was even in a Wall Street Journal article. They used the term soft landing. That was the top month in the year 2000. And they were using the term, all economists expect a soft landing. It wasn't soft. Okay. So anyway, once that delusion is gone, and sentiment goes the other way. And it wouldn't take much. I would say, for example, the S&P right now just nipped under 4,400. Okay. You drop another 10%. Now you say, oh, that's a lot. Not really. Not really. That's not even halfway back to the low of last year, which is just below 3,500 on the S&P. We argue that if you ever get below 4,000 again, the sentiment will have already begun to shift. But that's a point where you'll start to really precipitously drop again. So don't look at the 2022 price low at 3,500 as a measuring point. Somewhere just below 4,000 is a point at which any arm wrestling downturn that we get now, you get to that level and it won't be arm wrestling anymore. It'll be rapid pace. And at that point, I'm sure the Fed will have some either phone calls behind the news stories or overt news stories about something larger than regional banks.
And those waiting to get into the precious metal markets, should there be any waiting at this moment, or do you think we've hit the lows?
It's always an important thing to get in at the right point on a long-term trade. Our entry point for gold, after being bearish from 2012 through 2015, was a couple months off the low in February of 2016 at $1,140. That was our primary buy for our subscribers. We had a secondary buy after that 2012 flopping around action. 2018. We'd had a recovery off the 2015 low, then we waffled and gold went back down into the lower 1200s. The upper 1100s. And when it came up out of there, we issued a second major buy. When the gold market went down through the lows of the range of 2020 through 2022, the low end was 1675. There was a clear floor. It broke that last summer. When it did, we declared that would be a bear trap, meaning it's false. It won't sustain. When it aborted back above that low, it made the low in September, and October, November was roaring back up and rushed to the highs within a matter of a quarter or two. We issued another buy signal. So entering gold now, if you're a trader, you're late, and realize you're late. So your risk is going to be higher. But if I had to say right now, if you're not in it and you suddenly want to get into gold, then the pullback that we've had, a very protracted multi-month pullback, mostly redundant, up, down, up, down, up, down. The other day, we made a marginal lower low than we did in June. We actually nipped under 1900. Didn't bother me. Bothered a lot of folks. We think that the time spent on the downside is now near exhaustion on the clock. And there's certain measurements we have for defining the clock. You get much of an uptick here, like even, back over 1950 again. I would write it off. It's over. We're going back up again. There's going to be a rush. Silver has a level. Now, its rally this year got up above $26. Remember, its low was near 17 last September. It rushed up to over 26. Right now, we're trading either side of 23 today. I think we traded over 23 at one point today. You get back over 25 again, assume white knuckle flight is about to begin, that we're going to rush again. So I would say get gold above 1950 if you're waiting for some level of confidence to enter, and silver back over 25. Not the highs of the year, which were above 26, but get back over 25 again. And at that point, I would assume if you're not in, you better be in. And I think the temper and tone of those markets, gold, silver, and the miners, which are definitely a languished, lagging sector to gold, they always underperform on the downside. And there's points in bull trends where they vastly outperform, and which we expect this time. If silver gets back over 25 and gold over 1150, I think I would focus at that point on miners and silver. Gold's the mama, but I think I would focus on silver and the miners for better percent performance. And I think it's probably something you start to see an upturn soon.
Now, the last topic I did want to touch on is going to be the bond market. I know you have some concerns there. Can you expand on that?
Yeah, I think the long bond market, we turned bearish in October of 2020. Now, you look at a price chart, and TLT and T-bonds were way up there, way up there. They effectively crashed. The decline in price, the rise in yields that bonds produced, I'm talking long-term end of the bond market, the 30-year bonds, 20-year, that kind of stuff, not the short-term, was of the dimension of the S&P, let's say, and crashing down back down to its lows around 1,000. Had S&P done that in 2022 from its highs, upper 4,000, dropped down to about 1,000. That's what T-bonds did effectively in price. They went back to the price lows of 2009, meaning the yield levels. Okay. Then they had a rebound from the October low last year. They had a rebound. Sharp, lasted several months. But then they rolled back over again recently, and now they're testing that price low or the yield high. In fact, I understand on some actually daily closing yields of 10-year on out, we actually maybe nipped new high yields the other day versus the October highs. So we're now playing around at the highest yields we saw late last year, or the lowest prices. We don't think it's going to sustain. We think the bonds are going to turn back up, meaning yields are going to start to drop, not because everything's rosy, but because the central bank starts to panic. And because I think once there's a perception among asset managers that, the stock market rally is starting to roll over, they're going to seek some area of relative safety. And frankly, technically speaking, the bonds look like they'll be safe for a rally here, meaning a drop in yields. It may only last a couple quarters, but we think there could be a decent rally. But I think it will be coincident, bonds rallying, with the stock market rolling over and convincing people that the stock market rally's over, you better get into something safe. And right now, in our opinion, there's only two things: the gold sector and T-bonds. But the T-bond rally will be brief. It won't last a year or two. It'll probably last 6 months or so. But still, it will be a place for money to move. So right now, I tend to think that betting on higher rates in the long end is not a good idea. It's more likely we're going to get a drop there because of a sense of panic in the stock market again.
Fantastic. Well, Michael Oliver, we really appreciate your time and insights as always. If our viewers are interested in learning more, they can go to olivermsa.com, which is linked in the description here. Tell us a bit about that.
Well, there's a contact tab on that site. If you click it, you see my picture and my associates. I've got an email address there. Send me an email. I'll be happy to send you sample copies of the reports, gratis, and you can see the kind of work we do. We usually put out about 5 reports a week, including a very large weekend report. We cover all 4 major asset categories: stock markets, including globally, bond markets, foreign exchange, and the commodities, with an emphasis on gold and silver.
Fantastic. Michael, thank you so much for your time, and God bless.
Thank you, Elijah.
Miles Franklin Precious Metals is one of America's oldest and most trusted bullion dealers. Miles Franklin is A+ rated and accredited by the Better Business Bureau, licensed and bonded, and has 0 complaints ever registered. Here at Liberty and Finance, we are licensed brokers with Miles Franklin. To order, simply call us, discuss your needs, and we can let you know our live inventory, prices, and availability, and lock in your order over the phone. Once your order is locked, the price is held for you regardless of market fluctuations, and the metals are reserved for you awaiting your settled payment. Within 1 business day of ordering, you will receive an email invoice detailing the order and payment instructions. Miles Franklin accepts payments by bank wire, ACH or electronic check, money order, check mailed priority mail, and cryptocurrency. The fastest forms of payment are bank wire and cryptocurrency. Upon settled payment, metals will ship out within 3 to 5 business days. You will receive tracking information via email. Domestic shipping charges are $15 for any order under 500 ounces of silver or 10 ounces of gold. For orders larger than that, domestic shipping is free. The package will be boxed, fully insured, and labeled discreetly, with no indication of the contents inside. For your privacy, the name Miles Franklin will not even be on the package. To talk to myself, Kaiser, my brother Elijah, or my father Dunnigan, call 1-888-81-LIBERTY. That's 1-888-815-4237.